today then we have the finish of the week and we've financial planning and management for startups. So we've Kieran kicking off today, taking you through the financial planning, and then we'll have Pader coming in at about 9:45 in regards to funding and grants and IP. And then to finish off the session today, we have Alan Wexhead as our guest speaker, who runs a company called Plop, who has started from Plop and has come through our new Frontiers program here in Ireland, with the university here in Toulouse. So I'll introduce him when he starts off, but sure, take it away, Kieran.
No problem at all. Thank you, Anna. Good morning, everyone. Last morning, as Anna's indicated, so hopefully you won't be too sad when the week is over. Just circling back as I normally do, first thing in the morning. So we've covered a number of topics during the week, and you've had a lot to process and digest. I was just wondering, is there anyone sitting there with a burning question or anything that they'd like some clarification on once you went off and started doing your informal homework? Everything completely clear? Anyone have a think about what needs to be through for their idea to work in the context of testing their hypotheses or creating tests that would allow them to focus on a falsifiable hypothesis?
Morning, Kieran.
Morning, Sean.
Yeah, I suppose for me, I thought on my idea, just to try to rule out any assumptions in relation to my visitors coming to the farm. Let's say, that they really do want to get out into nature and explore. I think also a lot depends on the teacher in the school. Certain teachers have a very much focus on getting the children outdoors, and other teachers they may not have the skill sets themselves, and they may not want they may not wish to be shown up maybe for that either. I suppose one-to-one engagement and exploring that deeper would probably be important for me. You know what I mean?
And I suppose you're at the mercy of differing human natures, differing personalities, differing focuses and outlooks. And you're 100% right. We're all different. All teachers are different. I guess all school principals are different. And in that context, some of them will really see the value in this and will really push for it, and others, might be more academically minded, and time outside the school is time not spent learning and all that sort of caper. So you're very much at the mercy of that, and the challenge, I suppose, is to understand, well, how does it carve up? What are the percentage that are of this mindset, and what are the percentages that are of this mindset, and how can we be persuasive?
Yes.
How can we demonstrate the value? How can we, articulate that this is the impact that this could have?
Yeah.
And that's your challenge. And look, I'm with you. Fully understand and enjoy the benefits of being outdoors, being with nature, and how that grounds you.
Yeah. I suppose tying it into the curriculum as much as I can, I suppose, in my persuasion.
Absolutely. And look, your conversations are going to be not just at single school level. Your conversations are going to be maybe with some pupils themselves, maybe with some parents, and also with government departments and boards that are that have an influence and have a view as well. So I would be speaking with all tiers
Yeah,
all right
actually,
there.
you remind me and when you say that, something I had forgot possibly was the school board as well is probably be very
Very good.
influential. Yeah,
Governing boards,
yeah,
absolutely. Yeah, and they can exert influence on principals and teachers too.
yeah. Interesting one. Yeah, thank you.
Good. Okay. Well, look, we're gonna jump into
Sorry,
another
Kieran.
top. Yeah.
Yeah, Kieran. Yeah, can you hear me? Yeah.
I can indeed.
Yeah. No, I suppose I just wanted to this infamous area of IPv6 and that whole idea of trying to get the concise introduction. I just want to get your opinion on idea I have as regarding using an analogy for trying to explain it to people, because I suppose over time have seen that people kind of zone out fairly quickly when you just talk about try and explain the technical side of it. So I'll just give it a go anyway. It's basically the analogy being that the original protocol and the new protocol, and comparing the use of the fossil fuel vehicle, the diesel engine, and the electric. In that the fossil fuel engine is what we've always used. It's worked, but it's not sustainable. The damage it's doing to the environment, but more importantly, the actual resource is not there. Whereas the electric is the clean future, the only one that has potential for growth, and where all of the innovation is going to happen. Equally, too, in the middle, there is the hybrid, which is the transition phase where you actually use both together. So I don't know, is that just more contradicting the story, or do you leave that for a separate audience?
I mean, I agree with the fact that an analogy is good. First of all, so I think analogies can be good, and creating some way of allowing, creating some form of words that allows people to get it, very quickly, is really, something that you should be doing, just given the nature of the topic that you're talking about. I'm not sure that covers it though. In my head, I kind of get what you're doing and what you're hoping to do. And it's a big leap for me to make an analogy between that and EV versus petrol diesel powered cars. But let me have a think about that one too, Barry, because there definitely is something that you come up with there that would allow people to get it very, very quickly. And I understand your challenge. Your challenge isn't necessarily that there's a present state problem. Like I have a diesel car out the front of the house here, and so I don't have a present state problem in that respect. But I do understand the world that we're living in, and the what's happening with respect to our environment and all the rest of it. So I understand that there's a pressing need perhaps to make some changes. But I'm not under huge pressure to do that, in that there isn't a consequence for me tomorrow or next week if I don't. And you're in that same zone. But yeah, let me have a think about that in the context of an analogy, just to see if I can come up with something myself. I'm not sure EV covers it, but you're on the right track trying to come up with something. Okay, folks, look, we'll jump straight in. Let me just share my screen. And so this isn't going to be a session on here's how you pull together a cash flow forecast, or here's what a profit and loss account and balance sheet looks like. I appreciate that there's subtle differences to all of that across jurisdictions. This is just simply some key considerations around staying solvent during early growth for a for a slightly higher potential startup. We will cover off a wee bit around forecasting revenue and costs and the importance of that, why you would do that, sensitivity analysis, just thinking about, the various scenarios, optimistic scenarios, pessimistic scenarios, etc. Burn rate and runway. So, a lot of higher potential startups need investment, need external financing. Obviously you're going to be using up that money, and that money won't last forever, depending on when the higher level of revenues kick in, and a wee bit around budgeting, etc. So being solvent while scaling. So why this matters? Quite simply, a high proportion of early stage failures stem from cash exhaustion. They run out of money. And the investors aren't prepared to put any more money in for whatever reason. So a solid view of the world from a financial perspective lets you feel like you're in control, I suppose, first of all, lets you make decisions that might be necessary, allows you to change things with confidence, spot gap, etc., etc. So numbers, whilst any of us in business will have an obligation, I suppose, to pull together accounts to determine, how much money we're making or not losing, and ultimately how much tax we pay at the end of the year, etc. But for the purposes of this, we're focused on treating numbers as a decision compass. This is us taking control of our business from a financial perspective, and using that to guide our route forward. So the foundations for revenue forecasting. So you got to start with your clear revenue drivers. So number of customers, and when they come on board, or when they're likely to come on board. Number of users perhaps within each customer base, say for example, if it's a software product. Number of licenses, if it's a site license, for example, and what that converts into from a revenue per customer perspective, or a revenue per user perspective. Or, if there's other ways in which you're generating revenue, if it is actually products that you're selling up front, or if it's a service or a service fee, or perhaps if it's pure consultancy. So you got to have you got to begin with your clear revenue drivers and when they're going to kick in. You're going to build up a bottom up forecast. So it's the number of units by the price, by the timing, what that converts to into monthly revenue, and what that looks like then from a forecasting perspective in terms of how that revenue increases over time, stays the same over time, or whatever. But obviously you have a focus on driving growth. And you're going to layer in all of the assumptions that are going to be needed there. So from you first engage with a customer to when you are sending them invoices, there's time lags there. You will engage with a higher number of potential customers than actually convert into customers. So you have conversion rates to think about, and try and get a good understanding of. The ramp speed I mentioned, so that's just the time lag between that first engagement to when they're actually a customer. And then customer retention obviously is another important factor with respect to revenue forecasting. You've onboarded a customer, you need to keep them. They need to be happy with the service they're getting. So if you have an issue with retention, where customers are falling away within a couple of months of coming on board, that's going to have a knock-on effect on your revenue forecasting too. And you'll want to be well aware of that, and have an understanding of that, and take decisions around trying to ensure that those customers stay with you. I'm guessing everyone knows what break even is. Just to cover it, you know, it's the point at which your total costs and your total revenue are equal, basically. For higher potential startups that are perhaps in a development phase at the beginning, you're obviously, you know, there's more, the costs are high at the start, and that's generally why you have to bring in money. You have to bring in, you know, investment or bank loans or overdrafts or whatever it is. But you know, you need that cash up front to fund the period in which the total revenue is not covering the costs. And that break-even analysis is used to determine the number of units or the number of euros or that is needed to cover the total cost. And the total costs are made up of fixed and variable costs. Okay, so just very simply, it's very important to have a good handle on your break-even analysis, and any cash flow analysis that you'll do, you will, you know, if it's done well, you'll see the point at which you're likely to run out of cash, and you're going to be mapping out all of your costs, and your costs might be ramping up, and all of your revenue, and your revenue definitely will be ramping up, and you know, you'll build in the fact that customers perhaps won't pay right away and all of that kind of stuff. There might be a time lag between when they utilize the service or the product or buy the service or the product and when they actually pay. So all of that has to be factored in to determine or to ensure that you don't run out of cash. So cost forecasting. So you'll forecast revenue and you'll track your predicted versus your actual revenue. You'll be splitting fixed costs, rent, salaries, etc., and the variable costs, hosting, support, shipping, whatever. And you'll be tracking costs by phase. So your early stage activity, you know, be that the pilot, the you know, the early, I mean, quite often the early customer discovery phase is outside of the business. It's done pre-startup. But certainly some of these other earlier activities like piloting and what have you, typically would happen whenever you're in startup mode, when you actually have a business registered, and then commercial rollout and starting out at those early stages of scaling. Like they're all separate phases, if you like, and the cost structure, if you like, can be quite different as things evolve. So you want to track by phase, include any hidden costs, any, you know, you're going to include all costs essentially, including bad debt if that arises, including compliance costs, etc. But what you're looking for is a transparent picture of your gross margin, and your gross margin is essentially your revenue less your cost of sales, and your break even. The simple unit economic that you need to be aware of. So there's customer acquisition cost, CAC, total acquisition spend, divided by new customers. And you know, your spend, you need to keep a control on that, because that can run away on you very, very quickly. Because ultimately, if you're engaging with 100 customers and you're spending time, effort, money, resource, people, you know, on that, and you're only converting to one customer, then your customer acquisition costs are going to be very, very high, naturally. So, you know, you want to have a focus on that. Customer lifetime value. So that's your average revenue per customer over the lifespan of them being a customer, multiplied by the gross margin per customer. And you'd want to be aware of that as well, and ensuring that that number is as big as possible, and how you might grow that number. Sorry, let me just go back there. So yeah, and the relationship between them, e.g., like a healthy software as a service business, the customer lifetime value will be greater than 3 times the customer acquisition cost. and there should be a payback on that customer acquisition cost of less than 12 months. These are rules of thumb, shall we say. So you'd want to test those unit economics early before scaling spend. Sorry, did I see a message come in there? I can't access it for some reason.
Yes, Joaquin, Joaquin.
Gwen, yeah, sorry. Do you want to just tell us what your message or your question is? For some reason, it's because I'm in full screen mode.
I can read it here for you. We have a couple of questions in there at the minute. So we have Jock Quinn, if I'm saying it correctly. I have a message here when creating an MPV, we look for the cheapest way to build our product. How do we manage or take in consideration the costs for the development when not being a direct cost?
Do we take in the considerations, the cost for the development when it's not not a direct cost? So it's not a cost of sale per se, but it is part of your R&D spend, if you like. You know, so it's a variable cost, and that's the way to think of it. So you know, typically it's low spend. You know, your MVP typically, as we talked about yesterday, is it's the minimum viable that will allow you to ascertain whether the solution can provide value for a customer around, you know, a specific problem that they have. So it shouldn't be hugely impactful on the cost of the business. You know, it's really whenever you get into building your product into a market ready state that there's going to be depending on what your product is, obviously, depending on what we're talking about here, obviously a huge SaaS system with a back end and you know, with all that goes with that in terms of the development cost, in terms of the hosting costs, etc. That's going to be very different to, you know, a fairly simple you know, plastic product that perhaps you know, was talked about yesterday. So yeah, there's lots of variables there. It really depends on what it is that we're talking about there, Joaquin, if that makes sense. Barry, when creating MVP, we look for the cheapest way, yeah? So how do we manage or take into consideration the cost for the development when it's not...
Jacqueline's message.
Oh, you did. Sorry, very, very good. Yeah, no, I thought they were very similar. I was thinking, my God, great minds.
Yeah.
Great. So so test those unit economics early and before scaling spend. And some of that MVP stuff, guys, like, you know, if you take this, like in Ireland, for example, as is the case within a lot of other countries, if you're a researcher in an Irish university in Ireland, you can apply for funding from the State Innovation Agency, Enterprise Ireland, for commercialization. So if you have an idea or if you have something that's coming out of your research, something that, you know, requires that sort of university input, you can apply for funding, which is grant funding. So it's non-dilutory, which will allow you to focus on that whole MVP spend and doing early trials with customers, etc. So you can get the cost of that covered. And I know that's being talked about later on this morning, the various sources of that grant funding. But you know, that money will cover that expenditure, and that sits outside of the business completely. So that's worth looking into and thinking about as well from an MVP perspective. So customer acquisition cost, the fundamental unit economic that determines your company's capital efficiency, and ultimately its viability. So it's very important that you don't underestimate that, and that happens very regularly. Underestimation of the customer acquisition cost, because invariably it generally takes longer than you anticipate to get those first customers on board. So you can run out of cash before achieving product market fit. You can build teams and burn rates that their economics can't support. You can make promises to investors you can't keep, and you miss opportunities to design more capital efficient go-to-market models. So it's very, very important, customer acquisition cost. So your customer acquisition assumptions are built from the bottom up, and not from the top down. So it's those basic units of how many potential customers they need to engage with, built in a good solid pipeline, if you like, that allows you to take decisions and drive progress. So there's going to be channel specific experiments early on with measurable, or a big focus on measuring your conversion rates. You're going to fully load the cost so that there's no blind spots, so that you are accounting for all of the cost. There's looking at other companies, trying to benchmark yourself against precedent, and trying to gather up as much information as you can. And no doubt there'll be peer companies, there'll be other companies perhaps that have spun out of your university. Let's go and have conversations with a lot of those guys. And a recognition that the customer acquisition cost typically increases as you scale beyond those early adopters. And then looking at the various scenarios, best case, worst case scenarios, and planning for that, or using those scenarios to plan for that. So a simple example, like a founder projects a customer acquisition cost of €500 for their small to medium-sized business security product. But first channel experiments revealed costs were closer to over 2,000. So rather than ignoring this and that reality, it's okay, well, what can we do here to reduce this customer acquisition costs? And they pivot to a partner distribution strategy that brings the acquisition cost back under €700, saving the business before they burn through their seed funding. That's just a simple example. So the sensitivity analysis is just that. It's a what if on key levers. Like, what if we are not expensive enough? What if we're too expensive? What if customers leave us within 3 months, 4 months instead of the 2 years that we had anticipated? What if our customer acquisition costs are higher than we had anticipated? What if the adoption speed is slow? What if our support costs are ridiculously high? So it's looking at that and building 3 cases, being optimistic, being straight down the line, and being, pessimistic that things may not work out just as quickly as we had hoped. And then quantifying the impact on all of that, from a revenue perspective, from a burn rate perspective, from a runway perspective. How long before we run out of cash? But fundamentally, it's about sorry, bear with me. You go back up. So prioritizing actions, allowing you to take decisions, preparing whoever it is you report to, if that's a board or investors, whoever. And then you convert those sensitivity models into financial models to see what is the likely impact on the overall business. There's going to be situations where you could run out of cash more quickly. So you want to know, well, when is that likely to be? If things don't work out, if I'm 20% down on what I had anticipated, when's the month that I won't be able to pay the staff, if I have staff? And document your assumptions for each scenario, so that you're clear, so that you're covering everything, so you're not missing anything, and so that the whole team knows they're all bought into it. They all have fed into it. They all understand the situation, and you're all working towards a common goal. And then have your pre-planned triggers. Know when you need to go speak to investors again. Know when you need to reduce spend, for whatever reason, try and make the cash last longer. know when you need to start the fundraising process. And fundraising is something that isn't a quick process. So if you're likely to run out of cash, or you're going to run out of cash at a certain time in the future, you need to work back and have some sense that it actually could take 6 months, 8 months, 9 months to fundraise. And we need to start that process early to ensure we don't run out of cash, etc. And present all of this as charts for your team members, for your existing investors, if you have existing investors. So it's a quick visual of risk and opportunity that you're looking for. So understanding burn rate. So burn rate is essentially, all monthly cash outflow. That's your gross burn. Your net burn is your gross burn, all monthly cash outflows, minus your inflows, minus the revenue that you're generating. And burn will have a composition, obviously, and you want to know that. What are we spending our money on? Payroll, marketing, infrastructure, operations, etc. And benchmark versus peers to spot overspend. I also do work in sort of innovation management space, and sometimes that can bring me into looking at the finances of companies. And quite often, when you go into a business and perhaps they're not making as much money as they had hoped, and you look at the accounts and you look for a breakdown of, say, for example, indirect cost, indirect salaries. And you look at perhaps a company that's not making as much money as you can, you realize their indirect costs are just ridiculously high. And they have a lot more people than they need. And it's through benchmarking, through going off and digging and looking at other companies, perhaps other similar companies, you can see other similar companies running a lot leaner. And so, using peers or using other organizations to spot overspend, or having a good sense of what the spend portion should be in a business is very useful exercise to do. Even looking at things like, turnover per employee can be very, very useful as a very coarse measure. So a turnover per employee for one business that's competing with another business whereby the turnover per employee is maybe 80,000 per employee for one company, it's 140 for another. You got to question what's going on there. And calculating runway. So runway is essentially the current cash in bank divided by your net burn, and not defined by a period. You include expected revenue and new capital to extend that runway. New capital can obviously be ways of raising money, either further investment or other ways from banks, etc., or for friends, fools, and family. And then model your burn after funding to see what is your post-raise like. How long have you got before you might need to go knocking on the investor's door again? And keep an updated runway graph in investor packs. Investors will be very interested to know. We'll always be asking and trying to understand what the runway is, as well as some of the other measures as well around forecasting. Cash flow management. So profit is not cash, obviously. Cash is king. You live or die on cash in the business. So you've got to track the timing of receivables, revenue, when you're actually going to get paid, payables, taxes, VAT, corporation tax, etc. So know when they are likely to happen, kick in, and what impact that's going to have on your cash flow. So you want to maintain a very, very tight and accurate forward cash calendar. 3 months is a minimum. And things you can do to try and get cash into the business more quickly: automate collections, negotiate supplier terms. I mean, obviously, if you can extend supplier terms and squeeze customer terms, you're in a much stronger position than the opposite way around. And you know, there's a rule of thumb now that would say you would want to reserve 2 or 3 payrolls as a minimum safety. And that would speak to your 3-month forward cash calendar as well, in terms of being confident that you have enough money in the bank to pay the staff. And then, you know, overall build a rolling 12-month budget that's linked to your roadmap. So your roadmap is something that you want to be very confident around, or have a high level of confidence around, in terms of being able to achieve, that. John, it's sorry, I've just Sean's asked the question: where do I go to find the benchmark data on turnover per employee, for example? It's a good question. I mean, you can. It's sometimes it can be just, you know, you have to work these things out. You know, so companies produce accounts, and you know, you can go to Companies House, or you can go to you know, CRO in Ireland, and you can pull those accounts and get a good sense of what turnover is. Turnover are available even in abbreviated accounts. And you know, there are ways and means, I suppose, of finding out how many employees companies have. And it could be just that you have to go off and crunch some numbers yourself. You could look for rules of thumb. You know, and I dare say, within some of the market research centres, like Enterprise Ireland would have an information centre. You know, and there might be some information that will allow you to determine what that is. It really depends. Like for large manufacturing companies, for example, there's a general rule of thumb, or it used to be the case, that 100,000, 110,000 per employee is what you really should be aiming for. And for software, it's going to be higher. So you know, there are general rules of thumb that people like me, who've been round the block with a few birthdays under our belt, we just know instinctively. But there are ways and means, and ask questions as well. You know, talk to people. There's lots of people that you know would have this knowledge, particularly people that would have deep domain knowledge of specific sectors. But every sector is different. The food sector, for example, is going to be a lower turnover per employee than perhaps the pharmaceutical sector, for sure. Rolling 12-month budget linked to roadmap, as I say, start with broad buckets around, you know, product, go-to-market, operations, etc., general administration, and update quarterly with forecasts to be accurate actuals. You want to have the whole forecast be actuals. Okay, a lot of companies use this as a sort of a rear view mirror, use it in rear view mirror mode to see what has happened. But really, these are most powerful when you're using it looking ahead, and you're using it as a tool to take decisions on what to do next. But you're using it as an accountability tool, something that allows you to work towards a positive outcome, and not as a straight jacket. And there are investors out there that will try to use it as a straight jacket. So monitoring gross margin. So you know, gross margin equals revenue minus the cost of goods sold, or minus the cost of sales, divided by revenue. So tracked by product line or customer cohort. I've seen me going into companies that have a large range of products, and a company that's perhaps breaking even or not making a huge, are not overly profitable. And when you go through and do an analysis of their product lines, and you try and track their margin by product lines, you can get into the scenario whereby, you know, you start categorizing products to say, there's a couple of product lines that are profitable and have a percentage margin. That's good. We want to keep those. There are others that have a questionable margin. They're not losing money, but they're not making a huge amount of money. You got to question whether you keep those or not, and try and understand, well, what is the reason why we would? Is it to keep a larger account? Can we increase the price on those? Is there a price sensitivity? Can we increase the price, or can we reduce the cost of producing them? So that forces decisions. And then there's other products that are just losing lots of money. And again, you know, real serious consideration needs to be taken to getting rid of those. And ultimately then that can stem the bleed and hopefully create a healthier margin. But you use margin to inform everything: pricing, packaging, automation, you know, priorities, etc., etc. And beware of growth that destroys margin. It's spending lots of money to grow, and it having a massive impact on your margin. You want to be very sure of what the upside is, to warrant that decision from a return on investment perspective. And have a KPI dashboard. So core field, cash burn, runway, revenue, you know, customer acquisition cost, customer lifetime value, churn, margin, etc. So have a couple of metrics per function, and hopefully if you have a team there with a function owner that takes responsibility for those metrics. And just a simple one-page view that allows you to trend charts and you know, allows you to eyeball the owner for each metric to say, look, there's a metric here that's problematic, and what can you do about it? And you'll review that periodically, monthly, and you'll share those with the team. Look, you'll create monthly packages or quarterly packages. You'll keep investors updated with concise information, and that information will be focused on actions and learning, as opposed to you know, always being on the back foot from an explaining perspective. Present forecast sensitivities and runway clearly, simple, clear chart. Own the narrative on variances versus the plan. So you know, if things aren't going good, be in control. Own the narrative on that and speak to what you're going to do about it. Good news is why it worked. Bad news is how we'll fix it. And you know, all of this builds trust and improves your probability of getting further funding if you need it. Common pitfalls to avoid: overestimating the revenue ramp or the conversion, and entrepreneurs have a tendency to do that, or ignoring lag between sales and cash collection. And some companies can be notoriously bad at paying. And the whole scaling costs, product market fit, sorry. You know, these are pitfalls that scaling costs, for example, invariably are underestimated. And you can track lots of metrics, and some people are very focused on tracking lots of metrics, but some of the metrics don't really count in the context of cash or profit. So you got to question whether you should be tracking those, and you certainly would want to be questioning whether you'd spend a lot of time gathering that type of metric up. So that's just a whirlwind tour of trying to ensure that you can manage your finances in startup mode. Anybody got any further questions on that?
I have a question, Kieran, please.
John.
We're wondering, what's a typical payback to investors for startups?
It depends. You know, like there are investors that would expect 10x, 10 times their investment. So if they're putting in, if they're putting in 100,000, they might expect $1 million back. And there are high potential startups that are capable of delivering that for investors, particularly investors that are in early. You know, so obviously the earlier you're in, the better. and it really depends again on you know what's been negotiated at the beginning. So some investors go in and there's a defined percentage of the company that the equities that the equity stake that they get within the company. So someone going in at, for example, you know, 250,000 for 10% automatically values the company at 2.5 million. You know, so that's defined, whereas others can go in on what's called a convertible loan note. So they go in, they put their 250,000 in, but that valuation hasn't happened yet. And the valuation typically would happen then at the next round. So if you're in on 250,000 for a pre-seed, and then there's a seed round in 18 months' time, the valuation would happen at that stage. And founders prefer that, obviously, because they don't like being hemmed into a valuation at that very, very early stage.
Very good, thank you.
But it really depends, Sean. Like I know a very active angel investor in Ireland, who put a relatively small amount of money into a well-known business going back 5 or 6, maybe even more, 7 or 8 years ago. I think we're talking about 100,000. But he got 40x return on that business when it was acquired, which was very, very impressive, obviously. Janet, finances is critical in business management, and consistent evaluation is important. I couldn't agree more. Absolutely. And you'll have some investors that will really have, or will want to have, a very tight control, influence, will want lots of information, are very wary of what's happening with their money, etc., etc. And you'll get others that are very passive, you know, that are happy enough with the once every 6 months or the once every year update. You know, so there's a mix of all types of investors out there.
Thanks,
Yeah,
Kieran.
okay, yeah, I'm conscious of time, and I know there's another
No.
couple of talks.
Yeah, and I just wanted to say a big thank you from myself here. I don't know about everybody else on the call, but I certainly learned a lot in listening in this week. So it's been great. Your delivery was fabulous. So thanks so much for your
Thank
efforts
you.
this week.
Thanks a million.
Not
Appreciate
at
that.
all. Not at all. And I just want to introduce then Peadar Casey, who will be taking us through grants and IP. Some of those in Ireland here in the call might know Peadar. Peadar is working with a project within RISE called TUS Works. And I suppose TUS Works is really a program that's creating pathways to harness the creative and entrepreneurial interests of the staff and the students here. So Peadar's been on the ground over the last year, infiltrating research centres, students, and he certainly brought a lot of people to the table that we wouldn't have known ourselves. So Peadar, if you want to kick off, let me know if you can share them okay as well.
You might be on mute there.
I was talking to myself there for a while. Can you see my screen?
Yep.
Okay. So good morning, everybody, and thanks, Kieran, for a good introduction to the world of intellectual property and grant aid. I suppose a bit like what Anna has said, just quickly, I've been in TUS for the last 12 months, working with the research community primarily, trying to work on that alignment between activities and what's happening out in the world. I've worked all my life in an entrepreneurial environment, either in the public or private sector. And I suppose intellectual property and grant aid is something that, when you go into a startup environment, from my perspective, a lot of the start of it is very, very creative and it's exciting and there's a great buzz to it. And then sometimes when you come to the intellectual property and grant aid piece, it becomes a little bit more systemized. And I suppose this morning, I'm just going to go through, the logic of why that system is and where this comes from. Maybe just before we start, is there anybody in here on the call that has been involved in the creation of intellectual property or has worked on filling out a grant aid form in any shape or form? Either you can put up your hand or write it in the chat or shout it out.
And picking up the thumb. I do a lot of this, Potter. I help
Okay.
researchers in universities across Ireland with various funding applications.
So I don't know what this works. Okay. And the next question is, when you think of intellectual property, question is, what do you think of? And again, Aaron, I think Anna might have said this already, either stop me at any stage if you have a question or write a question into the chat. You might keep an eye on the chat, Anna, because I don't know whether it comes on my screen or not, but stop me if there's any question. I'll be honest, I suppose, when I looked at intellectual property originally, I used to kind of think, oh my God, here's another thing that has to be done. And why do you need to do this? Can you not just get on with it? And as I've got more and more into the whole process, I began to realize actually the value of intellectual property. And this probably feeds directly into what Kieran has talked about, where you're getting money from people. It creates visibility, I suppose, around the invisible. And that allows an investment or an investor, wherever it comes from, public or private perspective, to have a bit more certainty. So you can see here the definition of intellectual property coming from the World Intellectual Property Organization. And it's very much going back to the person and their creativity. It's a way of, I suppose, I often talk about intellectual property almost like a mortgage on a house. It's something that you have a right to, and then you can trade it. Sometimes you decide to trade it yourself and convert it into a business, or sometimes you might decide to license it or give the rights to some people. We'll go through in a second, just I suppose it's mentioned here, but the whole idea of design, patents, copyrights, trademarks. In an Irish context, the Patent Office is based in Kilkenny, and again, they have a very good website. Or even if you were ever involved in a process, from my previous experience with them, they're very good, either answering questions online, or if you want to go and talk to them, they'll set up a meeting and you can go and have a chat with them if you have something that you want to talk about, whether it is suitable for patents or copyright or trademark. And that's one of the things I would say, and I'm talking very specifically now from an Irish context, and I think the same as in an EU context. Public sector organizations are getting much, much better at having systems, not always, but having systems like this that are engaged with the user. And they're growing in the understanding of where, especially from my experience with the Patent Office, they're sympathetic to the inventor, because sometimes an invention can start on a napkin, and now you're transferring it into something that has a whole lot of legalities around it. So there is a process that you go through there. You can see here patents usually protected for 20 years. Patenting process today isn't, not my intention to go into the detail of this, because there's so much. It's to give you a perspective on what goes on in this environment, so that at some point in time in your journey, if you decide you have something that needs to be converted or can be converted, or you want to actually engage with licensing some intellectual property, then you can have an idea of where to go with it. Trademarks are like logos, brand names. Copyrights going back to, you know, music, literature. The design is to do with specific appearance. Probably some of the companies that would be most famous for their design would be Apple and Dyson. Trade secrets is in most cases what's in your head, which is what you find with a lot of entrepreneurs. Will tell you, you know, the best place to hold on to my intellectual property is in my head. That's not a problem while you're running the business, but the day that you come to sell the business, it is a problem, because how do the purchaser, or the day that you're looking for investment, what's in your head often has to get transferred into something that's much more credible, tangible, and tradable. Out of interest, if you go back and look at the history of intellectual property back through the centuries, it was originally set up as a way of transferring knowledge purely. It had less of a protection element of it, more to do with an expression. And I think if you read some of the articles about it, they talk about the Industrial Revolution being the time when that intellectual property became more about currency than creativity and transfer. And if you look at what happens a lot at the moment, you wonder, are we going back to the future? Because you do see more and more open innovation scenarios. This weekend in Athlone, there's a hackathon. There's going to be 250 people attend it. It's run very much on the basis of open innovation. It's sponsored by NASA and a number of other space agencies. But you can still have an open innovation system, but you might have an intellectual property protected within that. So it doesn't mean it's a case of one or the other. They're very much complementary to each other. Then you wonder, well, why bother with all this? What's the hassle? You know, why need to record it? And I think it's best, you know, described here by the previous one of the CEOs of 3M when he said, you know, research funding creates knowledge and ideas. Innovation transforms that knowledge into money. So there is a huge difference between having an invention and being innovative. And the single biggest difference is it creates income. So if you remember what Kieran was talking about for the last 45 minutes, it goes without saying, if you can't create income, you don't have a business, you probably have a charity and a hobby. So that's where the intellectual property becomes the part of that infrastructure, credible, tradable, transferable. You know, and again, this is you know, often can be a dilemma in a college and a research environment where I meet principal investigators who have an invention or have a piece of intellectual property. And when you ask them the question, do you want to start your own business? More often than not, the answer probably is something like, well, maybe, but probably not. I'd prefer to be part of a new business rather than to start it and drive it. And this is where intellectual property then becomes also very important, because now you're moving from that invention phase into an innovation process. You can see here as a, you know, illustration, innovation is to do with creativity and commercialization. But as much and all as we'd like to think it's a straight line, it's anything but. It's a messy process. Like I said, startup environment is about, you know, being able to navigate the chaos, and anything that you can do that helps to bring stability to that chaos is a help. That's where intellectual property plays a role. It starts to identify, you know, you may have an invention, but you don't know exactly where it's going to be used. If you look at in our pandemic times, one of the reasons that they were able to work at speed on a new vaccine was because a lot of the base code or the base invention was recorded. And obviously that was hugely valuable, but it also meant it was scalable within a relatively short period of time. You know, and that's sometimes you have intellectual property that's recorded, knowing exactly what's to be done with it. Sometimes you have a lot of intellectual property, especially in universities, that's recorded, not sure exactly what might be done with it. And that's a key part of what I'm working on at the moment, is trying to work with the research community to look at where their existing research and can align with challenges that are in society. And as importantly, or more importantly, look at working with the postgraduate or graduate studies office to align new research initiatives or PhD studies that will connect with what we believe will be needed in the future. Then when you move into the knowledge transfer field, you can see here, again, it's a process. You're taking something out of the lab and you're bringing it into the market. Obviously, your intellectual property in here is of critical value. To be quite honest, if you don't have intellectual property, it's very difficult to take anything from the lab into the market. Some of it gets transferred as know-how, where people become employees of organizations. But if you're talking about the scalable, the marketable, and the transferable asset, intellectual property is a key part of it. This is, again, from a student researcher perspective. You can see here what the World Intellectual Property Organization is talking about, that certainty in the world of chaos. You know, you see lots of statistics. I think the usual statistic that I see is that, you know, 10%, there's only 10% of businesses that succeed. I'm not sure what the percentage of research that's converted into intellectual property is, but let me reword it: tradable and trading intellectual property. But I would guess it's not any more than 10%, and it probably is a lot less. But like going back to the pandemic, you never know when this becomes very valuable. And if there's people here from Ireland, from an agricultural background, there was a company who had been very successful called Enfer, and they happened to be sitting on a piece of intellectual property around the medicine that was used at a point in time in Ireland when we had a disease that was called mad cow disease. I'm not sure the scientific name for it, but Enfer happened to have the solution. Coincidentally, I saw that during the pandemic, Enfer was also a provider of testing services during that time. And the reason it came to my attention was that they were listed as one of the people, I think, that had taken about £100 million in fees to provide the services for testing. And what you'll find in a lot of cases, some companies are very IP focused, and some companies kind of don't really consider it. The IP focused ones are, in a lot of cases, a lot of things to do with medical devices, pharmaceutical, veterinary medicines, obviously human medicine. And that's where on this stream, however, you now see, you know, with algorithms and the need to protect some of that, maybe more so to do with the hardware infrastructure. A lot of software is moving so fast, it's very difficult to protect. And even if you do protect it, you just wonder how long it'll be relevant. This is just a simple little summary again. You know, some examples of obviously the patent we talked about. The copyright is very much around creativity, the trademark, again, design related, identifications, and, you know, registering designs, trade secrets. As you can see here, usually tied in with confidentiality agreements, employee contracts, and usually maybe sometimes just tied in purely on the base of trust, which you can't forget about in the middle of all this. You know, I often say to people, you know, don't ever just look at intellectual property as something to protect yourself, because you must work off the basis if you're in an environment that you don't feel comfortable, maybe you shouldn't be there. So go back to the idea of having an investor. Yes, intellectual property is important, but don't use it as a replacement from trusting and connecting with the investor. The IP and any agreement is really there as something that's transferable. Here's an example, I suppose, of an Apple product which has a combination of all things: trademarks, copyright, and, you know, if you look at the press, you'll see, you know, I think it has maybe disappeared now. Some people here mightn't even have remembered Nokia. I'm sure our Finnish friends will never forget it, but it was, you know, a lot of battles went on between Nokia and Apple. Even if you look at the origins of Apple, at one point in time in its history, I think it took over a research center belonged to Rank Xerox, which they weren't really doing anything with the intellectual property. And a lot of people would put that down to one of the rejuvenation phases of Apple. But obviously that research center had documented and had intellectual property. And that was a good example of where somebody else can harvest the value of it, might have a different outlook on the market. From a student's or a researcher's perspective, you know, IP, you know, on a CV, the process itself is valuable and hugely valuable in terms of a methodology and in terms of value to industry. Obviously, it takes with it some financial and rewards and revenue. Experience around the idea of transfer of knowledge, transfer of technology. And the blurring of the lines between academia and industry, I think these skills are actually going to become more and more valuable. Obviously, the protection of it is to hold on to the stage of development. And you'll often have, you might come across terminology like background IP or foreground IP. Background IP might be where you have a piece of IP and you move into a college, you bring it with you. That's the starting point of a new exploration. And then you create foreground IP on top of it. When you move into a college, or when you're in that environment and you have IP, you open up the ability to access supports which you probably wouldn't have as an individual. And a lot of this is going back to this idea of risk elimination. You can imagine a lot of government funding. They don't want to just throw it out. Sometimes that gets criticized as being too, you know, channeled in the public sector and not open enough to the private sector. But what I have found is, you know, like any system, you find individuals who take the time to understand it. And when they take the time to understand it, they get the most out of it. And anything, you know, that'll give you a strategic advantage, of which intellectual property will always take it. This is just a slide that I often use for researchers, you know, the difference between a license and a spin-out. The license is where maybe you have a piece of intellectual property in a college, you're transferring it out to industry partners. The spin-out is much more complex, higher risk, takes a lot more time, but the originator of the intellectual property has a key influence on which one of these and is the main influence on which avenue they want to take. This is something that, from a university's perspective, why is the university interested? I think it's part of its contribution to society. It's a pillar of research. It influences primarily the ecosystem, and definitely in the type of an organization like the Technological University of the Shannon, very much around the regional influence and about embedding knowledge in local and regional ecosystems. So it's an important part of role of a university. Sometimes it's criticized that there is too much intellectual property that's locked up inside the university. And that's part of why a role like mine got funded by an Irish government initiative. Like any good presentation, and this is only just the halfway stage, but you know, leave it with a question rather than an answer. I can't tell you what is the value of IP, but you can see there's a trademark in front of you, and I don't know what value, if anybody, has put on it, but it's fairly substantial value. And there's a lot of things that hang off of that simple mark: the values, the ethos, and also, you know, the amount of challenge that somebody like Nike takes to fake goods. Does anybody have a question at this stage? I can't see the chat, Anna, but if there's any questions there now, before I move on to the grant aid, if I can.
No, nothing up there at the minute.
Okay. So the next question is, what's a grant? Again, it's a little bit like intellectual property. It's a lot of administration, a lot of bureaucracy. My advice: don't try and change it. It doesn't work. Somebody has put it there. Try and understand it, and I think then you can get it to work for you instead of having the feeling that you're working for it. But grant aid is primarily given from a public sector institute, government bodies. And the key thing to understand, I would say, when you're looking at a grant, is have a look at the policy that it's aligned with, you know, because grants, you do align back into a policy. Try and understand, why are governments deciding to put this money in as an intervention in a system? So, for example, if we go back to something like, you know, renewable energy, you know, in Ireland, if you had a wind turbine or a windmill standing 20, 30 years ago, you were seen as being alternative and probably a bit off the grid. Now, if you look at today, you probably can't go too far on any road, or especially on a motorway, without seeing a wind turbine in the distance. Now, between then and now, there was a huge amount of intervention from government policy to start with, and then usually coming behind it, financial intervention. Now, that's at a very big scale. If you come down to the startup scale and the type of grants available to startups, it's very much about stimulating a regional and a national ecosystem. And that's why the government are putting that money in. So when you're applying for anything, take a little bit of time to read back into why it's there, what's driving it. You know, financial gift or intervention. I'm not sure I'd use the word gift really a lot. This was a quote that I picked up on, but I left it there because sometimes it might be, and sometimes you often see now philanthropic, a grant or a gift, that's often coming from somebody's perspective that, you know, they recognize that some of it mightn't, you know, end up with very tangible or clear benefits, but they're willing to put money in there. Funding rates are typically between 30 to 100%. 100% is rare, and you are probably talking about the 30 to 60%. In an Irish context, we have an awful lot of grant aid coming from an Irish government, but when you look behind the Irish government grant aid, it's usually underpinned from a European perspective, and this is where you go back in and look at the policy. And anybody, you know, online that has any knowledge of the farming industry will be very familiar with, you know, grants that are an awful lot of grants that have been made available around environmental initiatives to solve challenges maybe with water quality or pollution. That's a good example of grant aids. And projects, programs, people, the people piece is, as you see here, very much connected back into a project. It's not just a person on its own. And obviously prime pieces of infrastructure. So prime piece of infrastructure for a business might be a piece of equipment. And maybe somebody with a very specific skills to run that piece of equipment would be applicable. Then at a training level, you have a lot of grant aid for programs. And we would engage with a lot of European projects that are more and more becoming and seen as pilot initiatives where you're hoping that there's a spin-off and a knowledge transfer to a wider community. As you can see here, it isn't free money. There's very strong usually KPIs associated to it. The second point here is, would say, you know, don't become a grantpreneur. I have one particular business that I know that got a very significant amount of funding from the European Space Agency to develop a key piece of technology for a satellite. It was very successful, got a lot of funding, probably in the millions, but now has a problem in trying to find out the application for that same technology down on Earth. Now, that's a kind of a unique scenario, but to see himself said to me, you know, he said, I went down a road, he said, that I didn't actually take enough account of where it was going to. And, you know, I suppose grants, they're relatively fast if you're aligned with the policy. But that's, I keep saying this, you know, they're there for a reason. And it's not just to give you a gift, and it's not just to throw it out to keep you happy. It's there to align with some policy that a government agency or a national government has decided. This is just a simple template. I won't go into this, but it gives you an idea of the type of planning that we would use with, and we need to do more of this, and we need to align this, and we need to, at one end, we need to do more with identifying with future thinking. And at the other end of it, we need to align with the appropriate calls that align with what we want to do. And I think at the start, Anna talked about this idea of, this is where we introduced this idea of pathways. It makes sense and common sense, but sometimes common sense isn't very common. And we have to go back to basics and start saying, okay, where are we going with this research? These are some examples of funding bodies. You know, engaging with funding bodies is a bit like, you know, and some of the role that Anna and myself do is a bit like a travel agent. We're trying to guide people in the right direction based on where they're coming from and what their aspirations are. But I would say, you know, don't get intimidated by it. And when you know exactly what you want, have the patience, and it'll start to become clearer to you. I was thinking when I was putting this together, what would be the key takeaways I would have for intellectual property would be, you know, it is about original thinking. It's there to record your creativity, but don't see it as something that you're just going to file. Record it and then work on how you're going to release it, either into your own business or a license, to ultimately create some kind of revenue for you and whoever is involved in the process. Grant aid is primarily a public sector intervention, and if it's not public sector, some of it now might be coming through philanthropic sources, and keep sight of the policy around which grant aid. And sometimes that policy, if it's coming from a philanthropic source, they have a policy. They have decided what they're going to invent in, or what they're going to put money into. You know, very recently I heard of a philanthropic fund, which was a little bit unusual, but I can understand why they said it's a relatively small fund, but still significant money that was helping with community development. But one of its criterion was that the money didn't go into sports organizations. And it kind of is unusual, but when you think about it and their logic to it, they said that the government had enough of those type of funding streams. So that's why they decided they weren't going to be part of it. So the person in question made a comment to me because they were part of a sports agency and they had gone and talked to them, but they obviously either hadn't available to them their strategy beforehand or hadn't read it. So that's the bit of knowledge I think that I have for you around intellectual property and grant aid. There are support systems to shape and scale your income or your business idea into income generation. So they're there for your benefit. Take the time to understand them. They are complex, but the more you understand about them, they become less complicated. Thank you.
Thanks, Pater. Thanks, Pater. Pater, we have about 10 minutes before our guest comes in. And I suppose in these 10 minutes, we might even have a little bit of time to share like how you found the week so far. So I suppose over this week, you know, we tried to create a week where we allowed you to shape your ideas and look at testing assumptions and your customer needs, looking at the wider market, designing your MPVs. So I hope you found it practical. And if you have anything to discuss over the last week or even, you know, the last 3 weeks that you've seen that we can try and clarify before you go into finishing off your assignments, because I know they're due on Monday and Tuesday. Also, for anybody in the call, I do know that the online bootcamp is still open as well until November. If anybody just wants to do the 2 ECT credits and the 3 weeks online, rewatch it and then have your assignments in at November time. There's a date there on the website for that. But also for those that are thinking about coming for the in-person week in Athlone and Stendon in November, that's also still open till Monday, so please get those applications in over the weekend. So I said a lot there, sorry, but in a wrap up, I just wondered how you all got on.
Yeah, Anna, so I might as well go. Yeah, no, it's been, I have to say, I don't mean to be smart as a technical person, but I'm pleasantly surprised at how much I enjoyed it. I have to say, not just because on the call, but Kieran's contribution this week was, I just have to say, was just like the far more useful to me than the previous. And I know that the previous was academic, and I know there was the language and stuff, but I just found the 2 hours flew by, and each of the days were genuinely one better than the next. So that's the good side. And I have to say, though, on the other side, that, you know, I suppose just that complete contrast between that and the previous two, obviously have the higher kind of academic focus, and like that, just trying to get those assignments and stuff. Just think maybe that needs to be looked at. And as I said, especially just even giving us the information, that comment where, you know, the detail is put in the chat, so that's only valid while you're on the chat, so we can't get that afterwards. So when if we want to catch up and go and look, to actually get at the information, I just think that piece needs to be just tidied up a bit. In other words, just a set format of the assignments and how to get the information. You know, like, so basically last week, if I went to look, if say even at the weekend, you couldn't actually find where the content was. I know it's the first go of it, whatever, but I think just that piece of it could be, you know, just
Clear.
make it easier to
Yeah.
jump in and out, because that's the nature of what the people doing this are going to
Yeah.
do. Yeah, they're not students, full-time students.
No, it's great, and there will be. I think it'll be early next week. There will be a survey sent around for feedback. So, you know, it'd be really appreciative if people are honest in it, because, as you said, Ian, it is the first iteration of this boot camp, and there are more to come over the next 2, 3, 4 semesters, 2 academic years and 4 semesters. So, you know, we strive to improve it, and hopefully so. The whole premise of this project is that it actually becomes, I suppose, within the faculties and is embedded into the university. So it is a pilot scheme, but hopefully it'll be here to stay. So the feedback will be great, to get honest feedback from everybody in it, so we can only improve.
So, thanks.
Thanks, Ian. Appreciate the kind words there. Glad that you enjoyed it. Anyone who wants to follow up with me, has any queries, is challenged in what they're trying to achieve, please feel free to reach out. My barra.ie, and just ping me an email, kieran.fagan. I'm more than happy to come back to you. I really enjoyed the week. I really enjoyed, Pater, and your presentation there. Brilliant, and given a really good appreciation of intellectual property, which is a very important consideration for lots of particularly knowledge-based enterprises, both from a, you know, unfair advantage perspective, shall we say, as well as a defensible perspective as well. And so brilliant insights there. Thank you for that. As well as the grant funding, which is always, free money is always good. And you want to capitalize on any opportunity to get free money into your project early on, because it doesn't, a lot of it doesn't take up, or doesn't look for any stake in your business, any equity in your business. So you want to take full advantage of that for sure. Can we show hands, just from the whole group, as to how many of you have ideas that you are focused on progressing with and hopefully turning into a business? Just to show, just a hands up. We have Barry and Ian, who I would have expected, in fairness. And Sean, I would have expected as well, absolutely. Lots of good questions from the three amigos during the week. Anyone else from across our European partners interested in progressing their idea?
Yeah, Janet has an idea. Oh, Jacqueline has said, where is the link for the in-person application? They've just actually, Jacqueline, sent on an email. I've just seen an email has been sent on to all, so let me know if you've got it, where you have great news that your extensions or your assignments have been extended out to the 10th of October. So let me know if you get that there. And if not, I can follow it up with it, Jacqueline, as well for you. Janet says yes, she has a business idea.
Brilliant. Great. And Jacqueline as well. And I see we have Alan joined us. Welcome.
Welcome, Alan. How are you?
Good, yourselves, guys. Good.
Great. Well, I'll just introduce yourself, Alan, and you can work away and introduce and add more to yourself. But a little short introduction I have for you. If I'm right in saying you run, operate, and are the strategy and technical direction of Plop, which is an augmented reality SaaS company for retail. Your team has been through and yourself has been through the Enterprise Ireland New Frontier program, and you went through that in our Heartlet Enterprise Acceleration Centre, which is based in Toulouse here.
Absolutely, way back in the day at this stage now. Went on after that to do like some funding with Enterprise Ireland, and we have a few clients around Ireland and the UK and as far as Japan as well. So, yeah, happy to. It's not too far long ago that I can't remember how I got started, I guess. So it's happy to share some insights there. So fire away. Well, I can't hear you anymore, Anna.
You're on mute there, Anna.
I put on mute. Yeah, work away. I suppose this week we've been all talking about MPV, customer discovery. So let us know your insights, the wins, the losses, the highs, the lows, and where you are today. And
Absolutely.
We've covered a lot of stuff, Alan, that you've no doubt covered yourself on the various programs, including your careers that you've been doing. And for some of the simple tools to crystallize your thinking, like the value proposition canvas, understanding the customer jobs game, business model canvas, how you create value for your business, customer discovery, how you go out there and validate your own assumptions. And MVPs we talked about, you may have in those a minimum viable product, you may not. But any activity that you did in that space, piloting and all of that, and please feel free to share. And then early stage go to market, and something to consider around that. Works and all, the stuff you did that worked, the other stuff you did that you learned a lot from.
Are you saying I might have made some mistakes along the way, Kieran?
You didn't give me a first.
No, so look, interrupt me along the way. Otherwise, I'll, you could be here till midday. And yank on the leash and guide me around as well. So if I'm, going off topic, just let me know. In a nutshell, I guess, like, I kind of approached the business, with almost, I suppose, I had a vast interest in the technology space that I was getting into with AR. And if anyone isn't familiar, I guess augmented reality is the ability to essentially preview a 3D item or 2D item in your space as if it was actually there. So if you want to see what a sofa looks like, you can press the button on our clients' websites, your camera opens, and you can just point your phone at your room and put that sofa there. So I'm sure we're all kind of somewhat familiar with the IKEA app. When we started, we were before the IKEA app, so it was a very new concept to lots of retailers. And I might just touch as well on the education piece for kind of new tech as well. But when we got started, like, there was very it was a brand new market, a brand new piece of technology. I'm sure it's something we're all familiar with today, and maybe throw something into the chat if you've used a tool like this before, whether it's ours or on IKEA or something like that. And I'm sure we're all familiar with, like, your classic Snapchat lens filters. That's all, let's say, a form of AR as well. As I said, when we started, it was brand new. So when we had to go around to retailers and, like, try and explain to them what it was always like, oh, so do we need a headset for that? Is that VR? Like, like, everyone had kind of heard of VR, and I think maybe the Oculus Quest and the Meta Quest was kind of around at that time, and kind of maybe a little bit more like in the papers, so to speak. And I'm sure we've all kind of felt this tidal wave with AI recently, and trying to explain to your mom what ChatGPT is. And that was kind of like what it was like for us going around to retailers. So nothing solves the problem like walking into a retailer with an iPad or an iPhone and showing them the product. And that was the game changer for us, really. I could have been hammering emails all the time, and kind of had that initial pushback from retailers to be like, oh, well, I'm not having our customers walk around the store with a headset on, like, and that's the kind of mindset where lots of retailers would have been at. So for us, I think the main thing really, I guess, was building it in terms of building an MVP. Like, before I even wrote a line of code, we literally just got the Apple demo that they showed at the time, installed it onto the phone. So literally 0 lines of my own code on this. Walked into the retailers with literally the Apple demo product chair that they were showcasing at the time, showed them, and literally every single one of their eyes lit up with the experience to be like, oh, it was super realistic. It was really quick and snappy at the time compared to anything else, even though they hadn't really used any other tools out there. Like, it was just the very, very initial versions of AORKit, which is Apple's developer framework for this. So and this was before it had to be in an app at that stage, and that's where we lost a lot of traction with some, with I suppose a lot of clients at the time. Was they were all very eager about the technology, but then it kind of came to, all right, well, how do we deploy it? How do we get it into the hands of customers? It had to be in an app at the time, and that's really where I suppose we spent a bit of time spinning our wheels with that, and eventually it became appless. So, you know, the tech caught up there. But what I'd say from an initial MVP point of view is spend as little time coding it until that delay between code and getting it in front of customers' eyes, and whether it's, you know, driving around to stores, showing managers in stores, like, you know, oftentimes you'll have, you know, you may not be chatting with the CEO as you walk into a furniture shop, which wasn't the case for us, but every store manager knows the CEO. They have their email, and they kind of want to be the one that's, you know, promoting some sort of new piece of technology, and that was our dynamic. I'm sure you can analogize it to any of your own businesses, whether it's an end user or a middle manager or someone who's signing off on it. Each one of them has their own KPIs, their own goals, and if you can help them get promoted, like, that's kind of the win that you should be aiming for, as well as you're chatting to them. I'd say to put a big old asterisk on that activity, where we saw a lot of excitement and a lot of enthusiasm and things like that, I definitely got carried away with my naivety at the stage, where we'd be like, oh, well, I've spoken to 10 people, they're all very excited. These you know, they couldn't have been more excited about this product, they want to use it, etc. Walked back into New Frontiers, got great feedback there, and they're like, oh yeah, great, Alan, you know, you're talking to the local retailer, start small and grow. That was like the local enterprise office attitude towards everything. Whereas what I should have been doing at the time, in hindsight, being 2020, was on a plane over to DFS headquarters, even though, you know, I barely had a suit at the time, was, you know, I probably bought the suit on the way to the airport, instead of chatting to the local furniture shop, who was just as enthused as DFS would have been. But when it came time to, you know, give me 10-20 grand a year, they were like, oh sure, Jesus, we'd never buy that, you know. You know, we don't even do Google ads, you know. Like, so, like, just knowing your market, and, like, you know, you can, as I say, you can have someone who is genuinely excited, but, you know, who gives a fuck how excited they are if they can't pay for the product. So yeah, that's what I'd say there. So, like, you know, you can kind of marry the two. You can have a bunch of those good customer lessons, but I know there's a lot of attitude, especially in Ireland, and with the kind of, a lot of the people that you'll run up against, is just be careful about taking advice from people who don't run their own bloody business. And like, don't, I'd highly encourage anyone to not start small and grow. It can be very, like, daunting and, like, let's say, un-Irish of us to embrace the kind of American attitude of, like, oh yeah, we're gonna, you know, raise 10 million and try and, you know, conquer this market. But that's kind of like what has to happen, to be honest. Otherwise you can just kind of get stuck treading water, and you're not playing for the big prize that's actually worth it, you know. You're doing all the same hard work, but, you know, you're chasing the local retailer for their invoice, as opposed to, you know, adding a zero and having it paid the next day by a big multi-corporation, like, you know, and you've done the same amount of work. Like, I literally had to give a story about this, is I literally had in the same week a local retailer stop paying me just in the middle of a contract, and on the next call with a, like, billion euro corporation, say, and we really respect your time, don't be working overtime on this project now, and, you know, the invoice has gone through, and it's like the the exact same service, if not more, that we're providing to the other guys. So, like, just focus on the people who'll kind of respect you and give you cash at the end of the day. I'd say that's enough waffling for me there, guys. Do you want to get any pointers or questions on the back of that?
Thanks, Alan. Thanks. So, Alan, like when you decided to start this idea, like why did you go into the New Frontiers program, Enterprise Ireland? You know, what were your thought processes in that there? Did somebody give you advice on that? Did you go seeking it or?
Yeah, like I kind of I had been much more in the tech side of things. Like I was kind of taught myself how to code, built a few apps and things like that. And like I knew honestly nothing about business. I didn't know how to add VAT to an invoice. I didn't know anything. So like New Frontiers was great for me at the time to be able to just kind of like hoover up all that elementary knowledge, I guess, you know. So you know the funding didn't hurt either as a you know kind of a time to try and find your customer base and things like that. But I'd say like and I chat with Mary about this on the regular. But like the number one thing from a New Frontiers point of view, that separated people who went on to either let's say give a very good effort at it and or succeed. Like they don't obviously always correlate together. But the main thing was just going out and chatting to customers. You can do all the business value propositions you want and all your desk research and all that stuff, but until you walk into a place and try and explain your product to someone and get some feedback on it and show someone something and you know have a few coffees, like you know I'd rather 10 coffees than 10 slides any time of the week when chatting to, like, let's say someone who's starting their own business. If you said, oh, I've spent 100 hours researching this market and I've put together my Porter's 5 forces and all that stuff, compared to someone who's like who comes back and says, oh well, I drove to Galway and I spoke to this guy, you know, the second person wins it 10 out of 10 times for me, to be honest.
Yeah. And Alan,
Yeah.
I'd say the rest of the group see that we've seen that with all our guest speakers this week. They've all mentioned the boots on the ground has been
Yeah.
the difference in their business and where their growth has came from.
Yeah.
Um,
And
is any,
I'd say it's not a comfort zone for me. I would much rather be like writing lines of code 24/7, like, you know, like it is nerve-wracking, it is not nice, it is, you know, but that's it. It's a fact. Yeah. Yeah.
and anybody else,
Uh,
any questions for Alan out there?
Alan Pather here. I
Hello, mate.
haven't met you before, but very interesting, and I have spent a lot of my time working with startups and mentoring, and I give people, and I didn't always know this. I wish I knew this a lot earlier in my own career, but I give them a piece of advice, and it sounds like it's connected to what you just talked about with the big business and the small business. I always say to people, sell to customers that want it, not the ones that need it.
Yeah, 100%. Yeah.
And it sounds like that was the case with your local supplier cutting off. He needed it, but he didn't want it. And your bigger business wanted it, and they appreciated then having to support you in whatever shape or form, i.e., pay the bill and recognize the fact. I mean, is that the norm or is it the exception? Or have, you know,
It's well, look, I think just by the process of data, it's the exception, but you have to just play the numbers game. Like I think it's a like if I load 100 companies into my CRM, 80 of them aren't even going to be like ready to buy it. You know, they're not in the buying window. They've spent their budget for this quarter, etc., etc. You know, no matter what, if it's the best product at the, you know, timing's off for them in some capacity. You know, like they're just not there. Of the 20 that are left, I would say maybe 10 just aren't like a good fit in some capacity. There's something off, like, you know, maybe they're changing their e-commerce supplier or something like that in the background. And then of the maybe the remaining 10, you know, then it's kind of like maybe it's up to that kind of like, let's say, a good sales process. It's you know, like what do you actually say in the call to them, what's your offer, what does it make financial sense, like, you know, for both parties, all that kind of stuff. So I'd say it is, you know, it is by processes of the data an exception, you know, that most companies won't want your product, but that's just an indication of like you've been able to reach out to more companies at all. Like I think one thing we kind of forget, you know, with Ireland is that like we're the size of Birmingham, like, you know, in terms of a market. And if you were to say to yourself, oh, I'm going to launch this product and like we're just going to service Birmingham, like, you know, like it would just be a wild business proposition. You'd laugh someone out of the room. But if someone says like, oh, I'm just going to start in Ireland and see how it goes, that seems to be something that like would not necessarily throw the same red flag in a presentation that I've seen. So I definitely say like we vastly underestimate how many businesses are out there, and how many people would be out there. So I think like there's an abundance, but it is by process of data a minority. Hopefully that makes sense.
Thanks, Alan.
Yeah, Alan, Ian Hollisey, TUS. I was the network manager here, whatever. I'm just doing the promotion, trying to promote the adoption of IPv6. So I suppose like my question and stuff I've asked everyone during the week is, and you've kind of answered it in the last one, but just kind of maybe some more detail on it, is the people you're trying to sell your augmented reality to, and you said about the small shops and that, but like the actual real customers, are they fully aware and know they want what you're selling? Is that what you're saying? Like, and then you have to be better or different at what they're doing, but you're in the niche, right? They only want what you're providing. And that's first question. And second question, are you making any utilization of IPv6, or does it come into your
Educate me here, Ian. What's IPv6? Apologies.
Yeah, that's what I was afraid of. Okay, so here after a week of practice with Kieran, so IPv6 IP, we're talking IP addresses now, not the other IP. So basically the original IP version 4, you probably have your 192.168. You've seen that number on your devices. They're just private addressing, but they're the original version, 1980s. They're all used up. IPv6 is a infinite number. It's a 128-bit long address space. The idea being you go back to the original of the internet, particularly for your type of work, where each device has an address, and then you can have endpoint connectivity without any NAT or any translating. So it's a big thing on scalability, routing, quality of service. That's why I was kind of thinking, is that anything that comes in? An example, Meta, for instance, their complete infrastructure is v6 only. They have no IPv4 address on their infrastructure. So it's for large scale. But I was also doing the analogy earlier for Kieran. It's a bit like the IPv4 is the original, it works. The v6 is the new thing, and you can have both running together so you don't even notice. So that's again, it's not a surprise that even someone like yourself isn't aware of the protocol. And that's really what I'm trying to get at, is trying to promote. The piece about it is 49% of the general internet accesses Google over IPv6. There's a lot of people using it, they don't know they're using it. So it is there. It's just to promote the use, and it is kind of a complex thing to do. It's an infrastructure piece. It's the boring piece. But
I was going to say, in my analogy, I'm probably the small retailer for you, Ian, to be honest. I think so for me, I'm piggybacking on a lot of these like big platforms like Meta, TikTok, Google Analytics, all that stuff, like, you know, AWS. We're using the platforms rather than building the platform from scratch, if that makes sense, you know. And like for us, what like where our kind of secret sauce really more is around kind of, let's say, the content creation piece for retailers that don't know how, and even if they do know how, just getting their content 3D ready rather than kind of like living in that 2D space. That's kind of our bread and butter. So to cut your second question pretty bluntly, it's not something that I'm looking at all, unfortunately for yourself. Ian, remind me on your first question. Apologies.
Yeah, no, was that you're neat, like, you know, the real clients you're going, they know what you're coming with. You're just proving that you're better and doing it, or You
There's a
can
bit of
give
that.
extra value than others. Okay.
Yeah, look, there's a bit of that, and you will, like, as I say, from the start, we were kind of explaining that, no, you don't need bloody glasses to use this. You just click the button on your phone, and we've kind of come now to, let's say, like clients or potential clients approaching us inbound and being like, oh yeah, we've done a lot of research, we saw you on this, we really liked it, can we sign up? And that's kind of the two ends of the spectrum there. There's people in the middle then as well, where it's like, hey, we want to do AR. Why do we want to do it? It's like, oh, we're not really too sure. Like, it's just everyone else is doing it, and then you have, let's say, a bit of buyer education, or let's say that kind of value proposition design, where we are, our first deal is a great example on this. We signed up our very first customer. I was on a startup program at the time, and like one of their mentors was like, oh, why did I sign up? And I was like, that's a crazy question to ask. I told them all the benefits, like, if they signed up for one of these 7 reasons that I told them on all of our calls. And I was like, all right, had our onboarding call with the CEO, and he's like, oh, just out of curiosity, why did you sign up? And I was like, oh, well, I just wanted to stand out compared to anyone else. And like, that wasn't even on the list of things that I'd said, So like, you'll have everything in there. And like, again, going back to, I suppose, like good proposition design, you'll have anyone who, like, the market will dictate some of that as well. Because as I say, like, he was the first one to have it in the country even before IKEA. You'll have then, let's say, discovering problems with customers to be like, there's the great onion analogy here. Chris Orlob on LinkedIn is quite good. He runs a company called P Club, President's Club. They do a lot of good kind of sales training. Basically, as the onion analogy, where it is, if you keep peeling back the problem until you get to something that's at a board level, that's like where you know you've kind of struck gold. So for example, with one of our customers, it could be we want to do AR so that we can increase our conversion rate, so that our marketing efficiency ratio goes up, so that we become more profitable, so that we can say this in our next shareholder meeting, which is due in 6 months. And that's kind of like the onion there. So when you're talking around, let's say, like, a publicly traded company putting something about your product into their slides, you're probably at the right, like, level of hair on fire problem. And then you can put it into, like, let's say, a 1-page value proposition design. And I'd say as well, for a lot of these deals, like one of our most successful deals, I've never met the person that's signed off on it. It's always been the internal promoter selling it on our behalf, which is, to be honest, more nerve-wracking than going on a call is waiting for them to finish their call. So I'd say just be ready for that, and kind of, let's say, being able to, like, build multiple champions in a business. Because if your deal lasts 6 months and someone gets promoted or cross promoted, and this happened to us, and it turned into an absolute disaster class. To go back to Kieran's first point of steps I've made errors with is let's say, like, having your champion leave halfway through a deal, and it gets swapped to someone else who maybe, like, vehemently opposed to, like, onboarding your product. Like, it's not a fun experience for anyone. Like,
Starting again.
Yeah.
Your onion analogy is a little like the tool I explained there during the week. It's the 5 whys. It comes from the Japanese Kaizen, 5 whys. So you're trying to get to the root cause of a motivation.
Yes,
and the theory is, if you ask why 5 times, you're essentially to get to that.
The Chris guy, he's got a load of like free downloadable content. I recommend anyone check it out. But he does have a much more polite sales focused way, Kieran, of saying why 5 times, because I'm sure, if you're on a sales call and you're talking to some VP of e-commerce and you ask him why 5 times, he's gonna hang up, and you're like,
why? Absolutely.
Yeah.
Speaking as the father of an 8-year-old, I generally find that after what you hit with why 5 times, there's no more responses. Like, that's where it ends. But you're right, there's probably a more sophisticated way of doing it.
Absolutely. No, look, it's there's lots of ways of doing it. So I definitely say check his stuff out. It's definitely helped me win a few deals. So yeah, 100%.
Brilliant.
So, folks, if that's it, we might give you 4 minutes back of your time this week instead of running over every day, which has been great. It's a great addiction to the reflection, should I say, to the online week we've had this week. So, I don't know if any of you have applied to come to the boot camp in Athlone, which is on the 10th of November. And then Stendon is on the 24th of November. So hopefully we'll get to see some of the faces again that have been on the call this week and some new faces. And Ian, thanks, or Alan, thank you so much for your wise words
Thanks,
today.
Alan.
It was great to
Anna,
meet you, and all the best to the
Anna,
business.
What's that, guys?
And I just seen Barry's mic going off there. I'm not sure if Barry has a burning question.
Thanks, Kieran. I do, but I felt bad because I didn't want to be holding people up. Yeah, is that all right?
Of course, Barry, shout away.
I had to take the opportunity.
Shout away.
I'm on a train. I'm connecting from train to train, so I'm all over the place. I'm missing a lot of that, but from what I heard, Alan, thanks. That's great. Thanks for presenting. It was great to hear, and Patter before that, and Kieran. I really enjoyed today's classes and all the classes. But Alan, my background is physio. 15 years experience as a physio. Currently studying digital health. I've gone through customer discovery process a couple of times now. Kind of pivoted a lot from wearables to detect stress as a prevention for corporations to now kind of, because that market is saturated, looking into more VR or even augmented reality. Actually, now that you've prompted that in my head, as a means to, some sort of visual analysis tool to detect stress. Or even I've other ideas as well, like maybe even the construction industry using maybe even augmented reality tools to kind of as a health and safety analysis tool. But do you see from your experience now? Obviously, you're an expert in the augmented reality in the design, but also now you're up and running business, and you have a lot of contact, or you have a lot of experience with different businesses now. Where do you see any of those examples? Do you see them as a good opportunity? And what advice would you give to me at this point?
Yeah, I'd say be cautious. I suppose like you need capital to build your own thing. Otherwise you're leveraging off the back of other platforms, and that can be risky. So for example, if I was to say to you, oh yeah, the new Meta Ray-Bans have a nice pop-up display, you could build something on that. It's like, yeah, you could, but in 6 months' time or a year's time or 2 years' time, Meta can decide, oh, we're not going to do those anymore. We're going to do something else, and then you're screwed. So I'd say if you want to build some sort of wearable thing or etc., I'd highly encourage, let's say, the American approach of, oh, we need to raise 10 million to build an MVP, to build a prototype, to go get it, a machine built in China to build like 100,000 wearables, like, and that's the kind of big brain picture I'd encourage. Or you go for kind of what we did and go really bootstrapped, and go very fast, and obviously, like with a lot of the AI coding tools and stuff that's out there, it's even more possible today, and build something really quickly on many platforms that doesn't let's say like tie you into one single thing, but that you can build and test quickly, and that you don't have to have that same pressure of oh, we've raised 10 million and now we had to pull the plug on our API, that type of scenario.
Yeah, so MVP quick. I'm kind of considering two ideas for doing that. One is taking advantage of the there's a grant available for I can't remember what it's called, for within the university that will give you up to 40 grand to build your maybe app or software for your idea, and then also to find a collaborator. Am I right? Yeah. Find someone that has built something already. So, but yeah, you're saying, yeah, I've heard that a few times. Just get something built and start using it, and build on that.
Absolutely. Can I put a bullet point on grants there for a second? There's a lot of great help with grants, and you know, I'm sure if I did some sort of financial analysis on the business, that I wouldn't be somewhere where I am today without some sort of form of grants or stuff that we've done. So I'll say that. But what I would say is there's a lot of, and someone said it to me, came up with the word to me recently, or maybe a few years ago, was grantrepreneurs, is people who just go sail from grant to grant to grant. They know how to fill out all the forms, and they're making, whatever, 50, 60, 100, 200K a year by filling out EI grants, local enterprise office grants, EU grants, all this stuff. And, they become absolutely like admin wizards at like creative writing tasks. But at the end of the day, there's no actual business to scratch under there. And once the grant runs out, you're scuppered. So what I would say is that especially with, let's say, relying on someone else to build a prototype for you, I would say absolutely do not do that in any capacity. Use them for a side project, use them for like we want to connect this tool to our app or to our program. Like, for example, if you wanted to integrate Google Health into your thing that you've already built, that's where I'd be like, yeah, go get a grant to do that and go get someone else to patch it in, and it's it's low risk. But for the likes of stuff like, like you've got Claude Code, Lovable, Jesus, I pay for like 3 more of them. They're all $20 a month basically, but you can go off and Replit. Sorry, Jesus, I need my coffee. Is like, all of these are maybe like 20 to $30 a month. And you can get an MVP. I wouldn't even say a good one, but like you can get something to show someone, and send them a link and let them click through it and find out where it breaks and all that good stuff. And you can do that through a natural language, like where it's, you don't need to actually know how to code. You're just like, can you please make the button red? And it goes off and does it for you. Maybe with a wearable health product or something like that, it may be outside the bounds of it, but for maybe someone who wants to do something a little bit simpler, a smaller SaaS product or something to try and test with, Christ, even just to get a landing page, I'd say even for yourself, Barry, is to say like can you get 100 people to give you $100 as a fully refundable preview to your thing, and then hey, I've got, what's that, 10 grand? Jesus, my maths, I don't know. Is you've got 10 grand
yeah, it's 10 grand, yeah.
Yeah, perfect. All right, excellent. All right, maybe I don't need a coffee. Is you've got 10 grand in an account, and you then can, like, you could walk to almost any like EWIS fund, like what's the HBAN, and say, hey, I've got 100 people to give me €100. As that's like just a big like seal of approval on your idea, like to be like, we literally can't wait for this product to come out, that we've paid him early, like that's the kind of itch that you want to be able to scratch.
So build something online that people can see or visualize what the outcome will be, offer them a chance to buy it prior to it, and then use that to prove that you have interest, and then that will let
you have a problem and a potential solution,
demand.
Yeah, exactly. Yeah, absolutely. And a market with money and all that good stuff.
Yeah.
100%. There's a good book on my shelf up there somewhere called Millionaire Weekend, and I'd recommend probably anyone try and do that. So it's like how to start $1 million company over a weekend. It sounds a bit fantastical, but it kind of changes. Again, it's one of those mindset shifting books that I think everyone on this side of the pond needs a bit more than the Americans. We could all be a bit more gung-ho about ourselves.
Yeah.
Millionaire Weekend. Yeah, thanks, Anna. Yeah, look, I'd say like definitely don't, like, same with a co-founder, like like I wouldn't pressure it. Like anyone who's getting a co-founder, make sure obviously like all your shares are vesting, all of that kind of good stuff. Or you could be in for a wild ride. But yeah, look, I think build as much as you can in house. Like, you know, there's very little stopping a lot of people nowadays, especially with, as I say, with all the AI coding tools that are out there. You know, if you can stomach 3 times or 4 times 20 a month on a few different platforms, find out which one's working for you best. Ditch 2 or 3 more of them, and you know, I guarantee you'll have at least a website that someone can pre-register and prepay on. Yeah.
Yeah, brilliant.
Yeah.
Brilliant.
Sweet. And
Alan, maybe
that's it.
you'll come back and be one of our mentors in for our for in-person week.
Oh yeah,
You've got a list of questions here. But folks, if that's all right, we'll call it a day today. And I wish you all, in Ireland, it's quite stormy here. We have our first storm here, so I hope you all have a safe weekend anyway, and we'll chat to you soon.
See you there, guys.
Brilliant.
See you.
Thanks,
Thanks
Alan.
so much.
Thanks, everyone.
Thank you.
That's
Brilliant.
it.